Hello everybody, in this video we're going to go through some options basics, okay? So I'm going to walk you through a real brief history of options in the US and Canada, talk about what some of the underlying assets may be when we talk about options. Then I'm going to talk about some real basic things when we talk about options, terminology, in the money, out of the money, premium, calls, puts, all this stuff. It's really essential. You need to get this in your head before you really start to learn the details of some option strategies. So here, the first point I have here, options contracts have been around for centuries and centuries, go back a long, long ways. Typically in the United States and in Canada, we've had some standardized trading of options contract on actual exchanges starting in the 70s. And really, one of the more prominent exchanges in the 70s and still currently is the Chicago Board Options Exchange, CBOE, and that was started in 1973. And so this was really an evolution in terms of options and options trading, really brought options to the mainstream investing community. And we really saw a big explosion in terms of different types of option strategies, tradings, and a lot of speculation surrounding there. In Canada, okay, this didn't really happen. The standardized options exchange in Canada really didn't happen until a little later in the 70s, 75, 76. And options were being traded both in Toronto and in Montreal. Okay, so two separate places. They eventually, joined forces together later in the 70s, 1977, and they formed what was referred to as the Trans-Canada Options Corporation. And this is where most of the options were traded in the late 70s. Now we see most of the options over on the Montreal Exchange, okay, the MX Exchange. We see most options in Canada traded there. And quickly, before we start to get into some specific terminologies, options can be written on a variety of different things. Most commonly, we see it written on stocks or common stocks. This is common. We can also see it in a variety of other types of underlying assets, such as, stock market indices, foreign exchange, agricultural products, metals, interest rates, lots of different things. And remember, an option is a type of derivative, right? When we go back to derivative, we talk about derivatives in general. A derivative simply means that its value is derived from some other underlying asset. And these guys here are those underlying assets here. And so we're going to get into some terminology and specifics to options here in the next slide. So let's skip over to the next slide and see some options basics. And let's really get into what is a call option and what is a put option. So here in this slide, we're going to see two different points. And for you guys that are familiar with options a little bit already, everybody should be very familiar with call option and put option. So these two guys, the first one, call options, this gives the holder of a call option, right? This holder is also the buyer. We're going to get down to that in a second. The right to purchase an asset for some specific price. And this specific price is called the exercise price or strike price, on or before some specific expiration date. So some major terminology here to get in your head. First of all, the holder. Okay, the holder, if we come down here, we can see the holder is already outlined here. This is the buyer of a call option. That means that you're holding calls, or you're the holder. You are the person who is buying the right to purchase, right? So this is to purchase or to buy a specific asset at a specific price on or before some specific expiration date. So maybe I was going to go out there and I was going to say here in this example, here's a December expiration date. It's a call option. This is the underlying asset. Here's the price, the strike price. So in this example, it's giving me the right, but a big point here, this right is not an obligation. I don't have to do anything. I'm buying this option. It is giving me the option. I have the right, but not the obligation to purchase an asset for some specified price. Here, I can purchase Apple for $150 on or before this expiration date in December. And that's going to be generally what a call option is. If we went the other way around and we come down here to what is a put option, this is going to be different now. Again, you're going to see some similar terminologies. You're going to see the holder. This holder is, again, you're the person who's buying this option, the put option, but instead of a call option, a put option, this is giving you the right to sell. Okay, the right to sell. You can see here, right, this here is much different than the right to purchase. Okay, so that's the first thing. Options basics. Put option giving the right to sell, call option giving the right to buy or purchase. And so back down here to the put option, asset for a specified exercise price on or before some expiration date. So very similar language we see to a call option. And again, if this was, instead of a call option, if this was a put option here, put option, this would simply mean, hey, I have the right but not the obligation to sell my Apple shares for $150 before this December expiration date. And within the contract, this expiration date is going to be a little bit more specific. Might say December 21st, usually the third week in December, or in the month, excuse me. But it's going to be a little bit more specific than this December here. And again, the seller of the call. Okay, so because remember, there's always two sides to the contract. Here in this case, we already know the buyer, right? He's going to be what's referred to as holder. If you're selling a call or you're selling a put, either way, you're going to be called the writer. Okay, so you're writing this contract. You're going to sell this contract. And because you're going to sell it, you're going to have some different obligations that surround your obligations in the contract. Now, if you're going to sell a call option, you have the obligation, right? So if you're going to sell a call, you have the obligation. You have the obligation to sell the underlying asset to the purchaser of the call at some point in the future if the holder of the option decides to exercise this. Okay, so here, selling call, you have obligation to sell if, right, if the holder decides to exercise his option. Same thing if you sell a put. If you sell a put, you're going to have what? Another obligation. But your obligation here is not going to be to sell, it's going to be to buy, right? You're going to have to take on this asset if the put option holder decides to exercise this. So here's a couple different sides here. Now, with that said, fortunately for the seller, if you're selling anything, you're going to be getting paid for it. And here, you're going to get paid for this right for the buyer, and you're going to get paid in what's referred to as the premium. So key takeaways, key terminology you need to have in your head as we go forward here. Number one, you need to know what a call option is. Okay, so you need to know that. You need to know what a put option is. You need to know this definition. You need to know what the exercise price, or what's referred to sometimes as the strike price. You need to know what that terminology refers to. You need to know who the writer is, or what a writer refers to. You need to know what the holder is, okay, what that terminology refers to. You also need to know what the premium refers to. We just spoke about that. The premium, definitely need to know that. And you need to know what referred to as the expiration date, right? And that's fairly straightforward. But those are some key terminologies to take away from this slide here. So let's go to the next slide and have some more terminology thrown your way. So here's the next slide, options basics, slide number 3. Here we're going to walk through an example. Here is an example of a call option on Apple stock. The strike price, or the exercise price, is going to be $190. The premium, what the writer of this option is selling this for, is $3. The current Apple stock price, right? The current price trading on the market is 175, and the expiration date is December 22nd, 2017. So let's say that we're in November, let's say November 22nd, 2017. You know, this is giving us the right to go out and potentially buy Apple at $190 per share on or before December 22nd, 2017. So we have about a month to go before we get to that date. Now, you know, when I look at this, or when common sense you look at this, you would say, well, why would I want to do that? Why would I want to buy Apple? Why would I want to engage in this contract $190 when the current market price is $175? I might as well just go in and buy Apple at $175 in the market. Fair enough. I agree with you. But potentially, maybe this Apple stock in the next month is going to shoot above this 190. So maybe on December 22nd, Apple stock goes to 210. Hey, now I have this contract that says I can buy it for 190. This might be a profitable opportunity for me. And so this is really where we're going to get into some of this additional terminology here. So when we refer to out of the money, this example here is an example of an out of the money option. Why is it out of the money? Well, because the strike price is actually greater than what the current price is. Right? So the strike price here is $190. The current price is $175. This is out of the money. Nobody wants this. Or if you're going to buy this, you're going to buy it for a very cheap price. Out of the money. We're going to talk about time value, intrinsic value here in a second. But that's what an out of the money option is. If you hear that being discussed, strike price is greater than the current price. And in the money is exactly the opposite way around. So here, this would equal the strike price is actually less than what the current price would be. This is for an in the money option here. Okay, so that's for that, that's for that. So here, if it was the other way around, if the strike price was less than the current market price, then all of a sudden we're in a different scenario. Then all of a sudden, hey, I can potentially go out and exercise this contract that I have, buy the stock for less than what it's trading for in the market, and potentially have a profitable situation. That's what's referred to as an in the money option. And the last one, out of the money, this guy here is simply going to refer to, and you could probably guess it already, the strike price is going to equal what the current market price is. They're just going to equal the same thing. Commonly doesn't happen, as you probably guess, but if it does happen, at the money, strike price equals the exercise price. Now, what is time value? What is intrinsic value? Well, simply, time value is going to refer to anything the asset is trading for, the premium minus the intrinsic value. So we have to look at the intrinsic value first here. So here, the intrinsic value is going to equal the current price of the asset. This is for a call option, and I should refer to, these are all referencing call options. If we looked at a put option, remember, if we looked at the put option, it would be the other way around. Current price minus the strike price. So in this example here, if we looked at that, the current price is $175 minus the strike price, $190. This would actually be minus 15, but this doesn't go negative. Okay, so that's simply going to be 0. Now we have done the intrinsic value. If we look at the time value is simply going to equal the premium that we pay minus the intrinsic value, right? So this intrinsic value that we just calculated over here, if I look up here, the premium's $3 minus the intrinsic value 0. This means that the time value is actually going to be $3. The full premium in this case here is $3. Okay, so that's a quick example of time value, intrinsic value. And lastly, guys, American style options, European style options. American style, any point up into including the expiration date, and European style only on the expiration.